Hi, I'm Peter Rose, founder of Longwood Currency Trading. How do you trade in low volatility environments? That's what I'd like to chat with you a little bit about today. So here's a low volatility situation. We just got done with a storm that, well, we probably picked up a foot or so. Could be a little bit more. But you can see this snow pile here that the plow threw up. That's kind of a low volatility hill for, this is New England, for goodness sakes. And here's an example of a high volatility situation, sort of kind of like, sure, the snowplow threw the snow up, but if we were to look at a low volatility snowstorm, then we'd get maybe a little pile that looks like this. But there's a lot of snow here, and so that indicates a higher volatility situation. And certainly there was a lower volatility event series that went in over there. What does this have to do with the currency market and trading? Well, there seems to be an issue in a lot of people's minds, particularly beginner traders, about low volatility. Well, we can't trade low volatility because of two things. Number one, well, there's too much noise down at that level. And number two, there's not enough volatility, there's no movement. How can you make any money? Well, let's go see. We'll jump on the whiteboard and have a little discussion about high volatility versus low volatility and what all that means and how you can trade the lower volatility situations. Okay, let's take a look at some stuff that I've drawn up on the whiteboard for you to look at. This is what you'd call, and everything is in relationship, okay? You could call this high volatility, and you might call this low volatility. And the reason for that is, and just strictly on an ATR basis, this ATR is 8 pips and this ATR is 2 pips. Now, if this was a 4-hour chart, then this is hardly going to be noticeable and whatever. And on a 4-hour chart, an ATR of 8 pips would be crazy, right? So the first thing you have to look at when you're judging whether you want to trade in a low volatility situation is, what time frame are you trying to trade on? What are you considering to be the volatility? So your time frame is that's this guy here, okay? Time frame. And then you're considering what the ATR on that time frame is. Now you got to remember the ATR is only 14 period, so you're not really counting back a whole lot. You'd sort of have to look at the full ATR graph to see if you've had an extended period of that ATR. You can't just have like if you're trading on a 15-minute chart and your ATR has been, say, I don't know, 7-10 pips on a 15-minute chart, and then all of a sudden you go into some news that just got released and you've got spikes and shit going all over the place at 20 pips or 30 pips, and then 4 bars later it all calms down and you're back to your 8 to 10 pip movement. Not only is that all that spike and all that noise, well, it's just that, it's noise, but it's going to throw off your moving averages, it's going to throw off if you're doing Bollinger Bands and all that kind of crap, it's going to throw all that stuff off. And so in looking at taking any trade, you're looking at some sort of consistency of movement in a particular direction with a particular momentum. That's where you calculate your probabilistic analysis metrics of, or parameters of whether price has the juice to continue moving. If you have a high volatility situation, your ATR is going to be higher than you would in a low volatility situation relative to the general ATR of the chart itself. In looking at the majors on a 5-period time frame, which is what I do, then a 5-minute chart has about a 5-period ATR on some of the majors like pound dollar, or right now in, in March of 2023, 5 minute time frame, five candle time frame, pound dollar is running about 5 pips. When it goes out to 2 pips, I'd say, well, you've got low volatility. If I'm on that same 5 minute time frame with a 5 period ATR and I've got 8 pips or 10 pips, then I'm going into some kind of high volatility situation. The longer the period of time that volatility persists, or the lack of volatility persists, gives you a better ability from a probabilistic standpoint of determining how safe it is to trade. For example, if you're going into this situation with an 8 period ATR and you've decided to enter here, this is your entry point because some magic signal was given here. And so you're looking for a price to go up, and you're looking for it to go up into here somewhere, which is, I don't know, maybe there's some chart structure over here. Whatever magic juju you use to figure this out, you say, I'm going to shoot for 12 pips. And so there's your 12 pip distance. This is where you're starting from, and you're hoping that this ATR of 8 pips will take you up, because this hasn't printed yet. You're just going in because this has occurred. You're trading here, and it's oscillating right now, and you're hoping that it's going to go up and hit this profit target that you've identified. This is the same situation that we have here. We've decided that right here, it's gone down, it's come back up, it's going up again. So right here, that's going to be our entry point. And what we're doing is we're looking at again, same kind of deal we've got here, creating some kind of a profit target in this area here. So you're looking for price to go from here to here, the same 12 pip distance. The question then becomes, how safe is it to trade in these two parallel type of environments? If I'm looking at this ATR of 8 pips to 10 pips, where the normal ATR is 5, then I have to expect that I'm going to get some retracements. Well, what happens if the ATR is ATR in a positive way? How about an ATR in a negative way? So I got a 12 pip pullback here. So let's say I entered here, price goes up into here somewhere, and then I go to the next bar over to here, and I'm good because it still goes up, and then all of a sudden it goes down and it drops 12 pips below my my entry point. So I've got a 12 pip loss, and maybe when I went in here I said, well, around here is a good point to put my stop loss, my stop there, and I can correspondingly figure out that on my shorter time frame my stop would be there if I'm entering here. So the question becomes one of the magnitude of the dollar value of your risk as opposed to the number of or the percentage of pips that you're going to be losing in the event of a loss. We're talking about risk management, not how much money we're going to make, but risk management. And so if I'm on this volatility, and maybe before this, this has been a 5 period or 4 period ATR on this 5 minute chart that we're looking at. Again, these are both 5 minute time frame. Both of those are 5 minute time frames. So you got to compare apples and apples. Well, you're comparing apples and apples as far as the 5 minute time frame, but it's certainly different from the standpoint of the ATR at this particular moment in time that we're looking at the positions. And so here's the danger. We are setting our stop in relationship to some structural thing or whatever that crap it is that you're doing that's consistent with what the candles are painting on the chart at any given time. And so that stop, you say, oh, well, I got to give it some room to breathe, so it's going to be 12 pips. I don't believe in any of this shit anyway, by the way, because I have certain rules that are different. But I'm just trying to compare the thought process that you look at when you're building your trading rules as to what you ought to be thinking about doing. So, for whatever reason, in this environment, with this ATR and these spikes, this 12 pip retracement, that's as far as I want to take. So I'm a 60-40 trader. I got a 40% chance that it's going to hit that stop. How many times can you be wrong at 12 pips on a normal 5 pip ATR to make that up in future trading? That's a quantitative derivation, mathematical derivation, that you have to work out for yourself from your risk profile. In any event, in this high volatility situation that we're looking at, we've got a 12 pip potential retracement for the stop. We look at this same chart that usually has a 5-period ATR. It's now down to a 2 pip ATR. And the reason for that is maybe we're at the end of the trading day, or we're at pound dollar, we're at 8 o'clock at night, and there's not much going on, or 5 o'clock at night, there's not much going on. And so price will begin to slow down. During your normal trading day, you get, let's say, here's your axis here, and you've got trades that are doing this all day long, and then all of a sudden you get to the end of the day, and it starts doing this, right? We call this a damped harmonic oscillator in physics and math. This price just goes and begins to flatline. Maybe that's the time period that you want to trade this particular pair, and this time frame is before you go to work in the morning, and that's the ATR that you're going to have to deal with. It's this situation you're going to have to deal with. You're not available to trade during this, let alone are you comparing high volatility and low volatility. That made any difference. You've got low volatility just because of the characteristics of when the two pair countries are the most active, and they're not very active in here. You look at any of the currency charts, the majors, I don't do crosses or exotics. You don't get good readings on any of that stuff, and you can't develop good metrics on them either. So on the majors, this is the kind of thing that you're going to see periodically as the two pair countries shift out of active range. They're still being traded, obviously, and you've got a 2 pip ATR. Well, most people would say, who are used to trading in this kind of an environment, which is either a regular environment or a higher volume environment, that, oh, I don't want to trade in here. I don't want to trade in here because there's no opportunity. I don't know what's going to happen. It's just flatline. It's doing nothing. No, it's not doing nothing. It's doing 2 pip ATR movements. And because perhaps this particular end of day thing was doing this kind of sweep up, though you're not going to sweep quite as much if you do a 50-period ATR, 50-period moving average, you may see that you're in a rising trend, regardless if you're flatlining. You're not flatlining straight. You're not doing this, but rather you're doing this. Okay, so those are your two types of flat lines, okay? And that's what I'm showing here. I've got a low ATR, but I am showing a trend. Now, trends are qualitative as opposed to quantitative in how you view them, because by the time you figure out that you're in a trend, it could very well be over. So it depends on, again, the currency pair that you're trading, the time of day that you're trading, blah, 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 all that other kind of stuff. But not to confuse that with the facts, we have a rising price on a 5-minute chart with a 2 pip ATR. So if you stack 2 pips on top of each other, in other words, if there's constant volume action going on, you would move 6 bars and you'd get 12 pips, which is what I'm showing here. In this period here where I take the thing, let's see, 1, 2, 3, 4, 5, oh, look at that, magic. In 6 bars at 2 pip ATR on a pretty consistent rise, I'm going to get my 12 pips. So I've got the same amount of 12 pip profit target as I do over here. But my risk is 2 pips, whether it's defined by some structural thing that I did here, or I just say, look, I'm just not, I'm going to do an ATR stop. You wouldn't want to go to a daily chart and say, oh, I'll do an ATR stop, because a daily will have 80 to a pound dollar right now is 125. It was 207 pip ATR at one point. So you're not going to say, oh, I'm going to have a generalized rule that I'm going to take a 1 ATR stop. Don't even go there. For some reason of your own trading plan, you are now in a situation where your potential profit target is 12 pips and your loss is 2, whereas you have a 1-to-1 your potential gain to this potential loss. It has nothing to do with risk to reward. It simply means that in this instance, to get 12 pips, if I lose, I'm going to lose 12 pips, as opposed to I'm trying to make 12 pips here, but I'm only standing to lose 2 pips. That's a much better probabilistic scenario for you to be in, as long as you can determine that this is going to go where it should be going, and that, as I've said so many times, is going to be based on and I've talked a lot about momentum, so I'm not going to define it here or go into it, but that's all part of what I do in working with students. I'm not going to show a chart to somebody, this is how I trade, and so the momentum is this, because that doesn't help you figure out how to do it. It takes a long time to teach somebody how to do this, and not many people really understand this. Instead of doing this, they go by fucking Fibonacci numbers and Bollinger Bands and all the rest of the shit that has absolutely no correlation with the underlying price action except for what the price did before, not what it's doing right now. I'm a physicist. I got a degree in physics, almost a minor in math. Momentum is totally different than what most people are thinking about. In any event, wouldn't this be a better situation for you to be in than this? Then you could say, well, how do I feel comfortable that this is going to happen more often than it won't happen, and I'll get stuck in a situation like that? Well, I don't know. It's called trading. It's called being able to look at these two particular scenarios over and over and over again, doing comparative analysis so that you gain the experience to simply come into your trading platform and say, I've seen this before and it ain't there, I'm seeing this, and I know I can trade it. So when you have low volatility, you have the same opportunity to make pips as you do in a higher volatility, but your risk is less. And I might just expand that out into the macro world and say, if you're trading on the daily chart, where your ATR is 80 to 120 pips, as opposed to maybe trading down on the 5-minute chart, where your ATR might go from 4 to 7 pips, you just might have to look at that longer-term chart for 4 or 5 days or 6 days in order to get 200 pips or 50 pips or 80 pips, regardless of the ATR, because it bounces around like this, right? And so if you're trading out on the daily charts, your risk is spread out over days, if not weeks. And the probability that this type of thing is going to happen. So if you're trading on a daily chart, is your stop 12 pips away? Well, I don't think so. If I'm trading on a 5-minute chart and with an ATR of 5 pips, and I'm chattering along, this thing is going to get up into an 8 or a 10 or 12 or 15 pip gain for me, far greater than the 200 pips or 300 pips that I'd be looking for on a long-term chart. And so I'll clip it and I'll grab 8 pips or I'll grab 12 pips. Do you understand that 8 pips is 0.8% gain per $1,000? So if I'm trading a $1,000 chart, I make $8. I'm sorry. If I'm trading one mini lot and I get 8 pips, I've made $8, 0.8%. If I'm trading a $100,000 account, let's just say to trade 10 lots at a time at $100 a pip, then $100 times the 8 is $800. That's a really good day's pay. It's about probably 3 times more than what the average person is going to make. You know, $300 a day, I think, is something $72,000 a year. So when you're looking at trying to set your profit targets, if you're a pig and you're trying to get 50 pips or 100 or 200 pips, you're going to have to wait for that, and you're going to have to withstand this kind of thing. Whereas if you're on these lower time frame charts, you may run into these so-called low volatility situations, but they are more predictable as to the continuity of the movement and not experiencing this kind of crap than you are if you are actually trading on this and you have to set that pip level loss because of the volatility. Because you don't have the volatility here, you can set very short stops. Because if you get it wrong, if I go in here and set this stop at 2 pips, and it turns around and it goes against me, and I'm out, and then it turns around and goes back up, I can get back up in here and I can get 8 pips instead of 12. So I've lost 2. So instead of 8 pips, I'm getting 6. Well, I mean, 5 pips per 1,000 is 0.5%. 0.5%. You're not even getting that in CDs today. Well, you are, but I mean, not long ago you weren't getting 0.5%. You're getting 0.05%. So don't negate trading in these low volatility periods, because if you know how to trade, not using indicators and all the other bullshit, because they don't work down here. Because the reason that people say, oh, there's too much noise in these low volatility times and these low time frame charts, it's because they don't know how to trade. Because the indicators don't work on these low time frames. A pin bar on a a pin bar on a 5-minute chart doesn't mean shit. A Bollinger Band doesn't mean shit. It just doesn't. It doesn't mean anything on a daily chart either. But it's a little bit more predictive, because you're not going to be trading intraday. You're going to be looking at 10 days out. So you can look 10 days back and get a better feeling for what the probabilities are that that's going to continue on, that wave is going to continue on. But why do you need a Bollinger Band to tell you that? You just look at the fucking chart. Oh man, I just can't believe the complexity that some people build into their trading when it's absolutely unnecessary, as I've just described here. If you have any thoughts or questions about that, you want me to go into a little more detail, let me know. We'll try to help you out on that. The only way to contact me, and the only way I will contact you back, is through email. I'm not DMing you, I'm not WhatsApping you, I'm not sending you to a Facebook group. Anybody that tries to represent, hey, hit me up on this thing or go to this, it's not me. All you got to do is when you get my little picture here on the comment section, if you click on that picture, it'll bring up the web page that belongs to that picture. And if the picture looks like me and you click on it and it doesn't come up to Longwood Currency Trading, guess what? It's not me. And boy, there's a lot of those out there. Don't get scammed. I will send you an email. That's the only way you'll hear from me. So, take a look at this before I shut her down one last time and get a little bit of a better feeling for how you would identify higher volatility situations as opposed to lower volatility situations based on the time frame and the ATR. Now, what you decide to do with that information when you've determined whether you're in a high volatility, a regular volatility, or a low volatility situation is based on the momentum, okay? All right, great. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.